Rebel One Live with Shawn Hill. He's a partner at Modern Ventures out of Chicago. Thanks for joining us today, Shawn.
You're welcome.
Uh,
Thanks for having me.
of course, of course. So Shawn is another New Jersey native. So proud to be from from New Jersey, but lives in Chicago at the moment. And to share a little bit, graduate of Rowan University. Previously worked at Great Lakes Capital, Chase. Ended up at DocuSign before shifting into an investment role at Modern Ventures, and has been there for the past three plus years. So excited to talk to you today and to garner some of your wisdom. So thanks for sharing that with the audience.
Yeah, thanks, Sergio. So,
I wanted to turn over to you, and if you could share a little bit with the audience on what is Modern Ventures.
yeah, so thanks again. Happy to be here. Happy to share my experience today. I think it's a little unique. I didn't take the current, usually not the current path, but just the sort of most worn path in ventures. So happy to share that today. So Modern Ventures is a venture fund early stage. We're typically a Series A venture fund, and our sweet spot for sure is companies that are between 2 and 20 million in annual revenue. So we like B2B companies, really B2B horizontal companies. Our thesis is a little different than most funds that play in our spaces. So we started, I think our founders started in 2008. Her first fund, the predecessor to Modern, was the fund. It was a corporate venture fund for the National Association of Realtors. So it was very focused on real estate agents and real estate brokerages and franchises and associations. And then 2013 spun Modern out of that fund, and the focus was still the same. We still did real estate, but it was more than just residential. It focused on multifamily, on commercial, industrial, sort of all types of asset classes, and then also the peripheral industries. So think of financial services, insurance, and home services, right? Because part of every real estate transaction, there is an insurance and financing and usually a services component around that. So our firm, lots of people like to sort of pigeonhole us into prop tech. That's sort of the new term in the last, sort of 5 years. We've been investing since 2008. So we were there before there was a cool term to it. So, but what makes us different is that we look more thematically than we do anything else. So, if you look at lead gen, that's not a real estate thing. Whether you're a real estate person, whether you're looking to lease or buy or do whatever, or whether you're a doctor's office, everyone's looking for leads, and everyone's looking for referrals, and everyone needs to communicate and run their operations. And so we really look at B2B companies that are applicable to our verticals. So how can we take a theme, like a business challenge, like I just talked about, or take a broader theme, like how do we have AI? How does that apply to marketing? How does that then apply to our verticals? So it's a little different route. Our founder, her first investment out of her first fund was DocuSign, which is a pretty good one. You hope to get one of those in your career. And so that's sort of the typical model, that DocuSign's not a real estate company. It's not a prop tech company. It's applicable to financial services and insurance and healthcare and all those others. And so as investors, for us, and for any founders on the phone, so the bigger the market, the bigger the return for investors. And so if you find really niche prop tech things, we don't really do that because we think that market's sort of small. It may be $100 million market, but we like markets with B's in front of them. And so we really find these B2B companies and then say, hey, we have this massive market with a massive channel and massive distribution. So we can do that. So that's our typical, sort of fund thesis. Again, 2 to 20 million in revenue, B2B or B2B2C. And so that's where we like to play. Now, some of we'll do some earlier or later, but that's typically our box that we.
And what is your typical check size? And do you guys lead in the rounds?
Yeah, so we just finished up investing out of Fund 1 for Modern, Fund 2 for our managing director. And so that check size, it was a $45 million fund. That was about 1 to 3 million. And it didn't give us an opportunity to lead a lot because Series A, tend to be, 5 to 20, depending upon where you are, West Coast or Midwest, and it doesn't give you a chance to lead. But we did actually lead one deal because a lot of our 70% of our money comes from strategics. So we were able to get co-invest and sort of punch above our weight class. And so that way, we could put in $3 million and go get $3 or $4 million more from our co-investors, and we could lead some. But our new fund is, we're fundraising now probably halfway to 125, and so it'll be the same thesis. We'll just write larger checks. So instead of 1 to 3, maybe 3 to 7, and we'll lead some more rounds that way.
Great. And and I know Modern Ventures. Can you share a little bit about what you think makes Modern Ventures unique?
Yeah, so certainly our investment thesis around, that I just spoke about. So one, I think unique is we've been investing since 2008 in this space, right? And so prop tech really got hot between 2015 and 2017. You had Fifth Wall come in, raise $1 billion, and SoftBank come in with $100 billion. And so, when we were raising, the last fund in 2013, 14, people, investors were LPs were like, that's a really nice niche, right? And we're like, well, it's like a multi-trillion-dollar niche, right? So, it wasn't sort of until there was a lot of buzz and other generalist VCs start coming in, and then your NEAs, and your general, they start coming into, and then, so I think what makes us unique is that we've just invested through cycles. So started in 2008, which was a terrible time to start a fund and be in real estate. And we had to figure out a way to do that. And part of that was the thesis was find companies sort of outside the space that aren't just beholden to real estate, because real estate's so cyclical, right? And so that's what makes us unique, is that our portfolio doesn't look like other prop tech funds, even though people label us as prop tech deals, or we do real estate technology. So we're highly unique in sort of what we do. And our LPs tell us they may be even invested in our fund as well as those other funds, because we bring them deals that are different than the ones they're seeing from other sort of domain specific funds.
That's great, especially, and it makes a lot of sense. I think looking at Chicago, because it's such a real estate and architecture epicenter in the history of the city. So
we've got so many great real estate company. At Baird Warner is the oldest real estate company in the country, right? And they're an investor at, we have these great sort of brands that are here, and then we have developers, multinational developers that are located here too. So it's a really good source, of capital here in the real estate space.
Awesome. Can you share more also, can you share with the audience what the Passport program is, and share a little bit more about it?
Yeah, so again, that's probably another thing I think that's a little bit unique to us. And so in 2008, we started what was then an accelerator when there was probably a handful. Now there's hundreds, if not thousands, of accelerators. But our accelerator is a little bit different. So we try to find great companies, and if they fit into our buy box of 2 to 20 million in B2B and business model, then great. If they don't, and we want to work with companies sort of earlier or later, we have this program called the Passport, which I run. And so it is not so much about product market fit or investment or anything else like that. There's no co-location, none of that. It's basically customer acquisition in our channels. So how do you get enterprise deals faster than you can on your own, right? And because we've been doing it since 2008, we had this sort of large sort of network that we built up of about 300 to 400 executives across the industry, right? That we just know, and that takes time to build, right? That just takes time to build. It's our LPs, it's broader network. And so how can we get our portfolio companies introduced to them, right? Because then we can affect our own return if we get them customers. And just other companies. And the reason that's important is because I told you a lot of our companies come from outside of real estate. And so they don't know the nomenclature, they don't know the pricing, they don't know the go-to-market. And so we have a company that came through the Passport that's IPOing, next week. And why would such a late stage company come through an accelerator, except they were B2C and wanted to go B2B to C through our channels. And so they were like, this is a perfect way to do it. So stage agnostic, it just sort of depends on what a company is. If they fit our sweet spot, great, we'll go do it. And then we bring those companies through the passport anyway, because it's the best way that we know how to add value, and they get to meet customers, and we help them really shortcut the enterprise sales cycle. So if you want to go talk to CBRE or Greystar or Central 21, go ahead. You can try to get that meeting with the CEO, or you can come through us and we can help you make that faster. So instead of taking 18 months to get the deal done, maybe it's 6 months, right? And so that's how we help out. And for us, Sergio, it helps us sort of de-risk our investments, because we can take an early stage company, see that there's really good value to the industry, and we can say, well, we think this is a thing, and then we hand it off, and one of our huge partners like says, great, I want to scale this across my portfolio. It's probably a good indication of us investing at an earlier stage than we typically would, right? So it helps us sort of get some seed deals that we wouldn't have seen before, and some of the later stage companies, it just helps as well. So it's really a de-risking mechanism for the fund, as well as it helps our LPs try new stuff that they wouldn't potentially see.
That's great. It feels very symbiotic, because
Yeah.
they're investing in you. They get to see deals. It's
Yeah.
part of what they're paying for, and then also the startups need, that they're trying to land sales at these large organizations to grow. So
We've had almost 107 companies across the 3 funds now that have come through, and so it's a pretty big bunch to pick from now. So it's really been cool.
That's awesome. Um, I also want the audience to learn a little bit more about you, Shawn. If you could share a little bit about how started studying business at Rowan, and then now you're an investor. How did that happen?
Yeah, well, I always say I'm just a state school kid from Jersey who somehow landed in venture, right? So I'm not a Harvard or Stanford guy. I didn't go down the investment banking path working, 16-hour days to do this. I took a much different route. If you asked me if I was, when I'm studying and when I'm 22, I didn't even know what venture capital was. I would never have told you I've been here. So a little bit of my story is I got out, I had a business degree. I was living in South Jersey. I just graduated from school, and Maryland's right outside of Philadelphia. And it was the summer of 2001, and I said, I'm moving to New York like everybody else, and I'm going to go get a job somewhere. And 9/11 happened, and that kind of changed that changed my plans. So I picked up and moved to Chicago, because I just picked another place that I really liked in January 2002, and I started Great Lakes Capital. And so I really started in the lending industry, in the mortgage business. It was pretty good after unfortunately after 9/11, sort of the economy tanked, rates were really good, and the business was really good. So being a 20-something, that was sort of the heyday of mortgages. And so between then and 2008 was a really good time. But I knew that I didn't want to be a sales guy my entire life. So I got in operations, and I took a bunch of different jobs. My last job before the crash was secondary marketing, sort of selling these loans to Wall Street, and everyone knows what happens then, right? So I knew it was time to go, because I could see the writing on the wall. I had a pretty good catbird seat to see that the crash was coming. And then I was like, what am I going to do now? Because you sort of had this black mark on you of, oh, you're just a mortgage guy. And it was hard in 2008, 2009, because there were hundreds of thousands of people. The whole industry got fired. So I took a job as a sales manager at a software company, and that turned in. I was there. It was Constellation Software, which was the largest software company in Canada by market cap. So they're basically they're a glorified PE shop, and they just acquire and manage niche software businesses. And so they wanted to figure out how to get into the real estate brokerage and agent world. And so they hired me to acquire, integrate, and scale like an enterprise system for real estate brokers. And I was like, I don't know anything about software, but I can sell stuff. And so end up running that business. And like I said, I was there for 7 years and grew that business, but it just gave me a lot of connections inside of the real estate world. And gave me a lot of insight into tech and scaling businesses. And then DocuSign came knocking on my door and said, hey, do you want to come over here? And I couldn't resist the chance to sort of get on a sort of pre-IPO. I'm an East Coast guy. Like, we don't get this like West Coast, startup thing. I got there, all the food was free. I couldn't even believe it. I'm like, I could eat breakfast, lunch, and dinner there. And like, it was just really weird for us Jersey guys to like get to a like West Coast startup at that time. Right. So first day on the job, I was at a conference, and my boss was with the CFO, and there was another woman there, and I introduced myself and ended up being my current boss now. So I said, hi, I'm Shawn. And she said, hi, I'm Constance. I said, what do you do? She said, I'm an investor. And I said, what do you invest in? She said, I'm on your board. I said, okay, would you like a drink? Can I buy you a drink or something? So we became fast friends. And then she just asked me to mentor for her startups, right? And so I became a mentor for Moderne at the time. And I really liked interacting with the founders, and I really, I've always wanted to be an entrepreneur. I was just too scared. And I really can like appreciate how hard it is to be a founder, and, sleeping on a couch and eating ramen noodles and not knowing how to pay bills and borrowing money. I was just a corporate guy that but I really loved them. And so this gave me a taste of entrepreneurship, but I got a paycheck. so that was really nice. And so, my background is, I tell you all that because I came from a very operational background, and it was sort of operational BD, enterprise sales. And that's not the typical way into venture. And so because our fund has a passport program, and because we interface so much with our LPs, and it was a perfect conduit for me to help our portfolio. And at the end of the day, that's what I do. I take the network connections that I built up over the last 20 years. I talk to our companies, our portfolio companies, and find out how I can most be helpful, whether that's go to market or pricing or business model or scaling or sales or whatever that is. And I put the two together. And so, I think the lesson learned there was like, get a really valuable network, and then use that to do, to do your job and to be effective. And so I know that's why I had this job, is because I can call the C-level suite in most real estate companies. And so you sort of build that capital over the years, and then you can take that. And then I landed at venture, and I said, I don't know anything about venture. and she's like, oh, we'll teach you that, right? We'll, and we've got our investment bankers and our PE guys and all of those other stuff. And your job is to really help our companies get enterprise deals. And I said, well, I can do that all day long, right? And so that's how the match happened. And it's been really, really fun. I love the interaction. Sorry if that story's long, but that's not the typical venture path. I took the operator path to get to venture. And if you find a fund, and a lot of funds now are, they have operating partners, and they have, if you can find one that's a little bit more hands-on, roll up your sleeves. Like, I just do the same thing. I just work in a venture fund. so it's been a really cool trip, Sergio, to be honest with you. And I never thought I'd be there, but I know how fortunate I am to be here now.
I love it. I love the, how you couldn't have seen it going forward, but looking backwards, you're like, oh, you're building relationships in the real estate space, and then now you're doing that for your portfolio, which in some VCs is called platform, but it's the same. Yeah. It's you're helping scale those ventures, making sure they're successful, which helps your returns, and it's compounds over time. So that's great. I know, we've been highlighting more investors that are outside of the coast. You talked a little bit about that, about Chicago, and also you mentioned some uniqueness. Can you share a little bit more with the audience on what in your mind makes Chicago and the surrounding region unique for investment? At least for venture capital specifically.
Yeah. So I call it my second tour of duty here. I told you my first, I got here, I was here from 2002 to 2006 and got here 3 years ago. My dad's from the South Side, so I've got this Chicago connection. And, from a venture perspective, the education here is amazing, right? I mean, we have we have programs with, with Booth and with Northwestern. And so we try to keep it local when it comes to sort of our firm and our interns and all these other things. So, I think there's just sort of lots of capable, smart people here. It's the New York of the Midwest, right? If you're from any Big Ten school, like, and you don't end up in New York or San Francisco, you're here, right? So I think one, you just have like an immense amount of talent in Chicago. The cost of living is low. So, compared to, I lived in San Francisco, I lived in Miami, New York, like other places. Like, so I think you get people to stay here because they can do that, and they can hire good teams here with local talent. Um, I've seen the ecosystem, even in the 3 years that I've been back, get tighter and tighter and tighter here. Like, we look out for each other. And Chicago has become the epicenter of sort of the Midwest VC, and whether that's St. Louis or Kansas City, or it's Milwaukee. Like, I do see Chicago just being, the central part of the middle of the country that tends to get forgotten. And so, we love Midwest deals. Valuations are normal, and every time a West Coast VC comes in and they just blow out valuation, like, people don't understand, like, as a founder, you have to live up to that, and a down round's not great. And there's a lot of expectation that comes. And so high valuations are awesome, but the other strings attached. And so, I think between having the schools, having people that from the surrounding areas just want to live here and stay here is really helpful. And like, building a business here in Chicago is much different than on the coast. Just from a capital allocation perspective, you can keep your burn a lot lower, and you can just recruit locally. You don't have to go anywhere else. The city has magnificent institutions and tons of talent in all positions here.
That's great. I remember when I went to visit M Hub and saw a number of startup pitch, and I was like, wow, this is refreshing. It's like the startups that the valuations match the the traction or the revenue that they had to date. So it was nice to
We
see
have
that.
great VCs all along the value chain here. I mean, we've got great sort of pre-seed, we have great angels. There's lots of money here in the angel community. There's great pre-seed funds. You have really good Series A, and you've got late stage, you've got the Pritzkers here. You've got later stage, the jump guy. I mean, there's lots of, you can just stay within the Chicago ecosystem for your fundraising and do pretty well. There's lots of talented funds here with lots of money. So
we just Rebel One we just posted some research on Chicago. In your opinion, want to know what do you think is needed to accelerate Chicago even further? I mean, it's the third largest city by GDP,
yeah.
right? Like, you talk about like the cap, like people being there all along the capital chain. How do we accelerate the number of founders being born out of Chicago?
Yeah, well, I think it's a couple things. Maybe I think it's a PR thing, right? So San Francisco, Boston, and New York and Austin, get the PR, and Chicago doesn't. But if you look at venture returns, they're better in Chicago than anywhere else, right? And so if you get past the hype of Sand Hill Road in New York and all those other things, then if you really are an LP and you're looking for returns, Chicago is the best place to be. The Midwest is the best place to be. The Great Lakes is the best place to be. So I think it's a little bit of a PR thing. Sort of the more that comes out of here that are big names that that IPO or get have big exits, the more we'll get there. I also think Chicago is very diverse compared to the Bay Area and parts of New York and Boston and others. And so that's an initiative that I think if you look at the community here, if we can figure out a way to help incubate some of our Latinx and Black, founders here, and we're trying, and it's happening, and it's not happening fast enough, but that will help as well. So we have this diverse place. Although the city can be segregated, it's still much more diverse than a lot of those other places. And so keeping, helping those founders, I think, is really, really important to growing Chicago just as a startup community.
Great. I know before we were also talking about mentorship of in the industry and just diversity in the startup industry as a whole, not only in the founder but also the general partner sector. You know, in the time where that now it's top of mind and people are focused on it, what more do you think we need? You know, maybe even at the emerging manager GP level.
Yeah. Well, I could talk for our whole 45 minutes or an hour on that, but it's been an interesting year. And, I'm involved in a great organization called Black VC, which is here in the city, which, Mike Assem, M25 runs, and Mike's great. And, to do that. And, I think it's one, people just have to know the stats. Like, I think it's a lot of education around that. And I think, you know, I think what's happened is that whole organization has just helped galvanize and get people in the same space. So the people on the inside can start talking about it. But what's really going to change is the people outside of that space, right? So, in my firm, I have a woman-led firm, another woman partner. We have the most diverse team page that you'll see. And, I always tell people, like, you can't start talking about diversity till you fix your homepage, right? If your team page doesn't look diverse, then you're not going to have diverse founders that want to come be part of your team, right? So that's the thing you can control, is your own homepage, right? Is your team page. So, I think that, I think we're really going to have to do some work, but it takes everyone to make that change. I don't think that it can be done internally. I think that I tell Mike and others, like, let's own our backyard in Chicago. Like, it's great that we have this nationwide mandate, and we're going to go out and we're going to take it from 2% to 4% or 5% over the next couple of years. But, like, what can we do here? Like, what can we do in Chicago? Because we have this unique opportunity because of the diversity that's here. With women, with Black and brown founders, even with white, like, we need white people as well have to be a part of this. Like, it only works if everyone is a part of it, right? Because most of the money comes from white people. Like, let's be serious, that's what happens, right? So, I think I've been mentoring a few GPs, and it's about telling the right story. I think it's so top of mind right now. And I took a little break after the summer because it was just sort of intense for a lot of people. And I was like, this is a long-term thing that we're not going to solve in a couple of days, right? And so 6 months from now, 6 years from now, we're still going to keep having the same conversations. So what are the right long-term things for us to do? And, I'm mentoring sort of 3 emerging, sort of GPs right now. And I said, the story can't be, I'm Black and it's top of mind, so give me money. Like, and that's oversimplifying it. But why? Like, do you have proprietary deal flow? Like, why now? Like, why? Like, there is data that says that diverse teams and diverse GPs create higher returns. Like, we need to tell the right story. And so a lot of it is fundraising is storytelling, right? It's why now? And what makes you different from everyone else asking me for money. So I think that's really sort of where I've been concentrating on, is what's the story about Chicago? What's the story about diversity here? What's the story about you as a GP? And then how are you going to differentiate? Because it's a really hot topic now. And maybe, hopefully, it's always a top of mind topic, but what happens next year? And do you want to do it now when there's 50 people raising versus next year when there may not be as many? Because this is a generational thing that we're going to have to keep doing. So, it's not easy to raise funds at all if you come from, if you're a Stanford MBA investment banker, worked at NEA for 20 years, it's hard to raise money, right? Just if you're not those things, then it's even more hard. So, I think for any GPs out there, when I tell them, it's like, let's tell the story and let's use data and let's say why now.
Love it. So and the same was it the same could be told for founders, but I love how you're taking the skills, the same business development skills that Shawn has.
Founders are the same way. Yeah. I mean, I would say the same thing to founders, like, why you? And a lot of times, and I'll just have one other piece I think that's really interesting is, my firm has come, I'm like, look, I'll take the reins. I'll bring back opportunities for you, right? Because a lot of people are like, I want to help, I just don't know how, right? And like, instead I said, let me go curate some things. Like, I'll go out and I'll canvas all this stuff. And so, look, anyone can write a check and people need money. So if you want to write a check and walk away, and that's fine. But let me bring back opportunities. So, how do you just bring back how do you bring opportunities to people that they know that they can just sort of do without having to think about it? Like, a lot of people, like, I want to do something but I don't know what. So trying to sort of source these right opportunities to get to people. And from a founder perspective, it's one of these really weird things that I think minority founders, and this includes women, like, they don't want money because of who they are, but they just want a fair chance. And sometimes it feels like you're just talking to me because you need to expand your network of Black people or brown people or and so I know it can be frustrating as a founder to feel that way, that someone's talking to you because you check a box somewhere, versus are they actually going to give you money? So my advice to those people are, keep trying, take the money if they're going to give you the money. If you are checked, like, take it. I don't know, I don't have a better explanation besides it's hard enough. Take the money when you can get it. But it's difficult. It's not a venture thing, or it's not an investor thing. It's a societal thing, and we'll have to work our way through it.
Awesome. Shifting gears also back to the prop tech space, especially and I'm gonna take a step back and look at this time, right? Like, we're in the time of COVID, so many people shifting away. I bet there's a ton of commercial real estate deals. I keep seeing commercial real estate debt being venture debt being a, a thing now.
Yeah.
What do you see? You know, what do you see are the major opportunities right now for especially in venture capital
Yeah.
and
So
in real estate specifically?
yeah. So March was interesting. So I've been through 2008, been through 2000. So, like, um, out of out of every cycle, there's opportunity, right? And this one is different because this isn't the financial crash anymore, and it's not housing related, right? So, like, housing stopped for like a month because no one could show homes, but housing is blown out. Like, year over year, housing is up, and you can see everything. Everyone's moving and migrating and doing, like, the residential market is through the roof, right? Multifamily and commercial and retail a little bit different, right? Multifamily is like, I'm just trying to collect rents, right? And commercial is like, I can't collect rents because no one's even in the office. And retail is like, no one's shopping, right? So I think it's a little bifurcated on sort of how it depends on what asset class you're in. If you're an industrial, I can't build fast enough. I can't build warehouse space fast enough, right? Like, and so you have these just differences in real estate, which then will lead to differences in how the startups in the space are affected, right? So if I was a co-working or co-living, not so good, right? If I was digitizing a process, or if I was a virtual tour company, or if I was doing anything sort of virtual or digital, like, accelerating. So it really depends on where you fall, like what asset class you fall in, right? Or what your business model is. And so everyone's affected. Doesn't matter where doesn't, sometimes your business is going to go up. And I have founders like, I feel really bad. Like, I'm doing really well. I'm doing better than planned, in a pandemic. But, like, there are some people that are out of business. And these are companies that raise hundreds of millions of dollars that are out of business. And so it's really been this shift of, I think, overall, if you ask our LPs, which are some of the biggest real estate companies in the world, it is accelerated digitization. And that's why you see DocuSign stock's been way up, and Zoom and all those things. Like, so you apply those to real estate. If you are in that space, you've done really, really well. It's anything that's sort of digitizing the process. And if you are either creating revenue or dropping expense, a lot of that time. So, like, rental incomes haven't gone up, so it's hard for for a REIT to charge more money. So what they have to do, they have to drop expense, right? And so if I can be if I can be a solution that helps drop expenses, then I can still help the bottom line. And so real estate's just been this really weird place of, if you're overexposed in retail or commercial, you're getting hurt. If you've got industrial or student or residential, you've sort of been okay. And so it just depends where you fall on that. So, but it's an interesting time. But I think even the companies that are in retail and commercial now are still looking at, how do I digitize when I come out of this thing? So I come out in a better place. So I think it's accelerated technology adoption, I'd say, after the first 4 months. Like, nobody did anything for 4 months, and now it's accelerating after that.
Awesome. Well, Shawn, I know we took enough of your time. Thank you for sharing your wisdom and insight on your story, but also the prop tech venture capital space today. So thank you everyone for watching. This was Rebel One Live. Shawn Hill, partner at Moderne Ventures. Thanks for joining us today.
Yeah, thank you so much, Sergio.